Hi, I'm Juan Martinez, Senior Editor at Harvard Business Review. Welcome to the Accenture Research Executive Briefing. Banking is entering a new era, one in which longstanding constraints are lifting. The convergence of generative AI, agentic AI, digital assets, and new business models is changing what banks can do, how fast they can do it, and the economics behind growth. Today, I'm with Michael Abbott, Accenture's Global Banking and Capital Markets Lead, and Francesca Caminiti, Global Banking Research Lead at Accenture Research. We'll discuss the key findings from Accenture's Top Banking Trends 2026 report and what leaders can do now to move from insight to execution. Michael, Francesca, thank you for being here.
Thank you, Juan. Pleasure to be here.
So, Michael, the report argues that banking is entering an era of unconstrained banking. What does that mean? What constraints are falling away, and why is that important now?
Yeah, it's a great question. We debated the title of this report, and here's where we came out is that when you look at the messaging that's out there around banking, you hear a lot about how generative AI is going to impact jobs and change and so on and so forth. But when we dug underneath the report and we looked at the trends that are really happening, was we saw not a world of constraints going forward, but a world that's going to be more unconstrained. In fact, the analogy I give to everybody when I talk about it is like there's a lot of Eeyores out there that the sky is falling, if you like Winnie the Pooh. And I think what the world needs and what the opportunity is from generative AI is much more Tiggerish, meaning there's a lot of opportunity out there when you look at the ability to put on additional people at a nearly marginal cost going forward. And that's the background of what we mean by unconstrained banking. It's about thinking of banking in this world where all of a sudden technology is changing literally every single job out there.
Francesca, what do you think?
Absolutely agree. We saw that this kind of constraints are increasing overall in the banking, and in particular across the money, the experience, the work, the technology, and the risk, and the competition. We think that there is a lot of opportunities, more so challenges, that need for the bank to be addressed.
Now, anybody can produce a white paper, but you actually did research. There's methodology behind the claims that you're making in this. Francesca, tell me a little bit about how you put the report together.
Yeah, thank you for this question, because we are very proud of the kind of research we did. Because we use a rigorous mixed method approach. We did 4 primary research for service across bank executives, commercial banking clients typically, but also retail customer, supported by economic modeling, but also complementary technique. So we did a research on the future of money because we wanted to understand the opportunity in the payment, where we speak more later about the perception agentic commerce or stablecoin. And then we moved to the research on the understanding the experience. So we called the 10,000 consumers in 10 countries to assess how the service is becoming more fluid. But also we did another very important research to IT executives in banking, as senior technology leaders, to understand the implication for technology side, to see what is moving on the modernization side, the platform, the open source, the software. So there are a lot of fresh data. We also leveraged our in-house and proprietary research. There is a lot of economic modeling. So this is a strong evidence-based research.
Michael, you've done a lot of on-the-ground conversations, board-level conversations, things like that to sort of add to that. Can you provide a little more context?
Yeah, I would say that when I'm looking back at the trends reports, this is the most research metric-driven report that we have ever created. And it's an interesting challenge because with these reports, you're trying to predict a little bit of the future, but you want to look at also what the data and trends are saying. So what Francesca and team did is they brought to life a lot of the future, looking at the present and what's occurring in the metrics that are out there today, both in what I would describe as real-time surveys from everything from executives all the way down to consumers, and also, frankly, a lot of primary research. Like, for example, one of the, I think, incredible findings in here is that technology expense has grown 200 to 300% faster than banking revenue. And we just didn't leave it at that. Francesca's team did a great job digging into why is that occurring. So when you go to a board meeting, and when I presented this, what's been fascinating is the data makes it real. And it makes CEOs and boards stand up and say, okay, This just isn't a theory. This is a fact.
And one of the things that you came up with as part of the report is dumb money. Michael, tell me what dumb money is, and how does dumb money get smarter, as you put it in the paper?
And I love to smile on that, Juan, because it's like we had this big debate internally that, could we say dumb money gets smarter? But if you think about it, does your money work for you right now? No, right? Your money just sits there. It sits either in your wallet, your bank account. It doesn't move itself. So just imagine a world now where all of a sudden you can program that money. You can say, hey, if you're sitting around idly doing nothing, I want you to go put yourself into a treasury bill. I want you to earn a little more money for me. I want you to pay off that vendor a little bit quicker to get that discount. And that is what this future of money is all about. That's why we said dumb money gets smarter, is that your money is going to start working for you because you can tell it what to do instead of sitting around idly in your wallet. And then there's a whole other part of this, which is the rewiring of the financial system that's been around since the days of the Medici, where we always had to move money from one account to another. And even in the digital world, we still move money or certificates, stock, from one account to another. Imagine a world now where the money stays in one place and you just simply point it to a new person. So that's what we mean. The very fundamentals of banking are about to be rewired in a way that makes money smarter, faster, and easier to use.
Francesca, the report talks a lot about stablecoin and how stablecoin plays into dumb money. Can you talk a little bit more about that?
Yeah, absolutely. When we speak of money, we speak about three different type of money that are appearing. They are in digital currency. They are three. The most important is stablecoin that is scaling dramatically. It is impressive to see what's happening, for example, in comparison with Visa network. What we noticed in the recent month, an incredible rising of the transaction volume. Going through on a stable coin on a daily and weekly basis, that much more faster than the Visa network. And this is continue to grow. This is really impressive. But there is not only stablecoin, there is also the CBDC, so the central bank digital currency, so the digital currency issued by the monetary authority. There are, at the moment, 135 countries are experimenting and trying to explore this. At the moment, only 3 are working really on digital currency. We think in Europe, they are much advanced because there is a really serious program to launch a digital currency. The third is very interesting because it's sort of, given that these things happening a little bit outside banking, the third is linked instead to the response of the bank, which is the tokenized deposit. In the wake of the digital currency, it is the transformation of digital of the deposit. And tokenized deposit is also increasing very fast. It is at the moment, there is a lot of experiments, a lot of banks that are trying to propose a tokenization deposit. Some banks are working on both, but based on our survey, we can say that 87% of big banks are exploring tokenization as a complementary tool to issue this digital version of the traditional asset. This can improve liquidity and also settlement flexibility. I can mention JP Morgan, that is working actually in both sides, both stablecoin and tokenization particularly. In Europe, there is a consortium led by a number of banks that are experimenting this. So this is why we say dumb money gets smarter, because money, as Mike was saying, can be programmable. There is a better rates, there are more richer data. So this is incredible change indeed.
Okay, programmable money. You're going to have to explain that one to me. I sometimes think when we talk about technology, we speak in too vague terms. Could you tell me what programmable money looks like and give me a concrete example of someone who's doing it?
It is for programmable money is particularly we see in the corporate treasury. In the report, we cite Siemens. Siemens is a large multinational operating in 190 countries, managing transactions almost more than 100 currencies. Siemens is working partnering with JP Morgan Payments to modernize the fragmented treasury network. So they are using blockchain, virtual account, API, and programmable money to automate payments and liquidity transfer. This is, I think, is a great example because the achievements are very important. So there are 50% reduction bank account, 70% less management effort. a lot of automation classification.
Mike, what do you think about that?
Programmable money is about the ability for money to actually move on its own without you having to go in there and constantly say, move this from A to B, right? And you can do it on terms that you can set beforehand.
One other term that I like from the report is agentic money. Agentic is a term that we're using ad nauseum these days. So please tell me what agentic money is. And Mike, what's the easiest way to explain it to a CEO that isn't, up on the terms?
Yeah, so agentic money, think of it from the consumer and retailer's point of view for a second. Today, when you go to a website, you choose what you want to buy, you put it into your shopping cart, and you check out. Tomorrow, you're going to go to a GPT engine and say, I want you to buy me the Nikon, D7 camera. And here's the parameters I'm going to give you. It has to be shipped by this date. I want it to be within this price range, and let it go. In that case, agentic money now, what you do is you create a virtual account that is specific only for that purchase, that now the agent can go out there and make the payment on your behalf and figure it out. You can let the money figure out how to make the payment. That's what agentic payments is about. It's about enabling a completely different way of buying going forward.
Francesca, I think the term that was used in the report is agentic commerce. Is that what you would call it, agentic commerce?
Agentic commerce is an incredible change. We are early stage, and we saw a very important signal on this kind of move on the platform. So the money can become always optimized rather than idle. So we see also there are a lot of business leaders that they believe that this will be the future.
So what we're discussing here seems like a really, really big shift. I mean, my banking experience 3-4 years ago is pretty similar to what it is now. What you're saying is something entirely different. So Francesca, what are CEOs getting right? What are they underestimating? What can they do better?
Okay, good question. Because you say your own experience. So an experience that started some years ago. Many years ago, a lot of things have already changed in banking. Think about what digital and mobile app have done in the banking experience, because the digital mobile enable the customer to have contact with banks more often and to do a lot of things on their own, on our own. But as Mike said always, this makes the banking to be emotionally devoid. So it was functionally correct, but emotionally devoid. We now clearly see that the customer wants something different. They have proceeded, they have another kind of experience. And probably they want something that was part of the past. So this is a mix of future and past, because they want the previous experience that was typical of the teller in a banking branches, but also with a more faster, more flexible, more innovative. And we think that the AI can bring a lot of opportunity, because of the conversational banking, it is something real. 71%, based on our research, of the consumer would like to have an AI assistant in the primary mobile banking app. So we see that there are a lot of interesting from the consumer side to use the AI assistant for the bank. And it was not happening before. So we are in front of something that is super strong.
Michael, so what are executives struggling with here? What do they need to do in sort of to keep up with the change of acceleration of technology?
Yeah, and I think Juan, your question was you had around customer experience, right? And in particular, and there's a lot of things on the technology side that goes beyond that. But in customer experience, what we found, and the research is crystal clear on this, what customers want is what they had 30 years ago. They want a relationship with the bank. They want a bank to remember them, to know who they are. And I would argue that it is also clear on this, in becoming digital, every single bank's the same. Like you said, your experience hasn't changed. By the way, if you look at app ratings around the world, they are all 4.7 to 4.9. It is a sea of sameness, right? And in creating that sea of sameness, banks have become functionally correct and emotionally devoid. And what customers want is that context back. And what's happened right now is generative AI is coming at an exact right time. If you think about your experience talking to ChatGPT, it remembers you, remembers where you left off, where you started. That's what banks want. And by the way, what is that? That's what a branch manager did 30 years ago, which is why Francesca's data also tells you that 2/3 of all customers, all age groups, want a branch near them. The bottom line is, as we become digital, we can check our balances, pay our bills, but we forgot that there's a customer on the other end of it. And if you ask me what the number one thing bank executives need to do, is they need to remember that there's a customer on the other end, and they want to have a conversation with them, not push them down a journey of their imagination.
That sort of contradicts the whole agentic, right? Like we're going to put agents in charge of our money, but we want a relationship with the bank and we want a bank we can trust. Tell me a little bit about the trustworthy aspect of this and why that's going to be so critical to this.
The trust in AI is a great question. So first off, generative AI will enable that type of personal behavior. So I think it's an enabler to kind of move us beyond this functionally correct, emotionally devoid world we've created with digital. But the stats from the research, this is why the research is so critical, will tell you that I think it was like 35 and maybe now it's 45% of the people want agentic AI. This reminds me of the age, back in the day when people were afraid of using mobile. It will increase over time even further than that. But what's more fascinating when you dig underneath it is they want agentic AI, but they want you to put brakes in the process. They want to stay in control. So I think it's close to 80% of people say, yes, I want an AI experience, but I want to approve it before it makes a decision on my behalf. So the future of customer experience here is very clear. It's going to be, again, kind of what it was 30 years ago with a branch manager. We have a conversation and you can decide going forward. I think the future is incredibly bright on this.
Francesca, what do you think? People still want physical connection, but how does that play into the sort of digital aspect of it?
Yeah. Let's start from the digital first. And I think that Mike is absolutely right. So the banks have this kind of trust advantage. Of course, they needed to execute things fast and responsibly and provide very nice feature, very, very. For example, there are some early movers that are starting to provide a very nice example to understand, to confirm how the pace is accelerating. Think about the BBVA, the Spanish bank, which is one of the most important digital bank leaders in Europe. They are developing an app embedded in a ChatGPT through an alliance with OpenAI. So BBVA is demonstrated to develop the first conversational app concept connected to ChatGPT in a couple of countries. You can imagine how much is incredible interest in this. Among the digital challenger, we can also mention Starlink, which is a UK fintech. They are using a plain language queries to become very easily. For example, what the feature is, how much did I spend on grocery last week? You can use this with plain language, and they can deliver instant breakdown and chat responses. So again, there is a sort of possibility to leverage ChatGPT and the bank to work together. So about the physical connection, it's a bit a paradox, because from one hand, we see customers are increasingly digital, and also they leverage mobile, and we can count more than 150 mobile touch points per year. So it's true. But at the same time, branches still remain the preferred channel for some activity. For example, the most complex activity where advice is needed. So we know from our survey that 63% of the consumer like the idea to have a physical bank to orchestrate the life. It is a sort of symbol of stability, and it is very important because it is still ongoing. 76 want to micro branches. Of course, there are some differences between the generation, but branches still count. Mike, I think you can confirm this trend.
Yeah, no, I mean the death of the branch has been much exaggerated out there. In fact, it's fascinating because the research shows us in a world where none of us know what is fake or real anymore. Even across all age groups, everyone wants a branch near them. Not because they're going to walk in there, because they're not. They just want to know it's there in case they need it. It's kind of like an Apple store. Just in case I need it, I know there's one nearby. If I get in trouble, I can get out of it. And it's fascinating. It's going to be a key part of the brand strategies, I think, for the major banks going forward, despite digitization.
Something else that's really important is the notion of the 10x bank. Mike, can you tell me what a 10x bank is and why it's critical here?
Yeah, and this goes again right back to the title of the report, Unconstrained Banking. I when we looked at this, we saw a clear differentiation between what I would describe as leading banks versus following banks. And leading banks are treating Gen AI not as an opportunity for the few, but as an opportunity for all. And when you step back and you look back in think about 1980, and Excel had just been, it really wasn't Excel, it was VisiCalc back then, but everyone predicted the end of finance people because Excel was going to take all their jobs, and it didn't. In fact, it actually increased the number of finance people out there because it enabled us to do more. So if you roll that analogy forward to the generative AI age, instead of thinking about the few people that you can take out, if you thought about the many people you could create for a marginal cost, that every person could basically manage 10 people, all of a sudden you think about banking in a very different way. And in fact, when I go to boards, I like to say, if you're a bank of 20,000 people, I don't think you're going to be a bank of 20,000 people going forward. And they generally pause and they think, oh, it's going to be smaller. And I say, look, no, I think you're going to be a bank of 200,000 people if you do this right. You need to be thinking about this in an expansive way of what more you can do with these capabilities, not about how you can contract. And that is what a 10x bank and thinking is about. It's about thinking unconstrained about the future.
Francesca, whenever I see a news report, it says nobody's generating any revenue from AI. AI is not producing anything. It's a bubble. We should get rid of it. But the report shows that there is ROI coming to these banks for their efforts. Can you talk a little bit about how they're seeing the ROI and maybe give an example of a company that's doing it well?
Absolutely. We see a lot of evidences already, also because also in our new research that we just delivered in the Pulse of Change, when we ask the bank executive where is the opportunity, they do not say cost saving, they also say revenue growth. And indeed, we did a lot of analysis, including our revenue model, in which the revenue increase is something that is real, it's happening. And also we see some banks that are delivering there is opportunity at a better ROI than effort. This is coming from big banks are really expanding. I see the opportunity as the what bank Mark was saying about the 10x banking. There is a real example. Think about BNY Mellon. BNY Mellon has integrated AI-powered digital employee with a distinct identities like human members in a team. That is incredible, interesting. There is also the email. BBWay expanded the tool initially to 11,000 employees and got an improvement of productivity of 3 hours per week, and now expanded to all the 120,000 employees. So there are a lot of banks that have started to scale AI with these gains. We see a lot of achievement in 30% higher workforce engineering, faster KYC processing, did all of this a fraction to cost. I want to add another point about the classic idea for the worker. Typically, the workers worry about the job security. History has shown that technology sometimes may expand, might also increase opportunity. So AI can create a new value and careers, not just efficiency.
Mike, I recently edited a piece that's in the Harvard Business Review. The title is Stop Running So Many AI Pilots. And the point of the piece is that banks just seem to be running tons of small little surface AI pilots and they aren't working. In your report, you sort of touch on that too, that banks seem to be stuck in the pilot phase and they need to branch out from it.
Yeah, and I think calling them pilots is being generous. I call them science fair projects, right? I think the banks are running. I think there's a lot of science fair projects out there, and they need to get out of the science fair and into the scaling question. And what we find, it's actually quite fascinating. Believe it or not, some of this comes down to culture, right? It's because what is needed in the bank, and it's a talent question, is you need a culture of curiosity, hence your pilots and try, tempered with execution. And by the way, that's where we see the difference occurring in the great banks versus the marginal banks. And what execution comes down to, and I don't have stats to prove this, but just having been around and led banks myself for most of my career, it comes down to not confusing collaboration with consensus. And what I mean by that is everybody wants to be collaborative and get the input. But what happens is when you seek consensus, one person can stop it from going to scale. So what we see in these banks that are stuck perpetually in the science fair pilot mode is that they are seeking consensus and one person's saying no. The ones that are doing it great have the leaders that say, no, thank you for your input. We're moving forward and we're going to roll this out. Because many of them I find actually know exactly what to do and how to take the expense out, and they're working it and it's working in the pilot phase, but they're not putting it out to scale because they're afraid.
Let's shift gears a little bit here. There are so many cool phrases in the report that I like. One of them is high cost of low cost. Mike, what does high cost of low cost mean and why are you seeing so much of it?
Yeah, the high cost of low cost is something when we started looking at this, we started looking at technology expense, and you'll see in the report that technology expense for banks has been growing 200 to 300% faster than revenue. And the question we always get at the board level is why? Why is that growing like that? And when we dug underneath it, and what Francesca, the research she did and her team was fantastic, because what it showed that despite putting $3 trillion into digitizing the front end and building great experiences, right, as we talked about before, what happened was on the back end of the systems, banks have made a number of low cost decisions to just maintain the status quo, often code that's 30, 40 years old that it runs, don't touch it. So we describe those as low cost decisions. But what's happened is, and the statistics are clear, is those low cost decisions have now accumulated to be a very high cost. And that cost is that 70% of tech time is simply maintaining old systems, meaning only 30% of your tech budgets for people typically go to building something new. And that's what we mean by the high cost of low cost, is that you have to be thinking about now over the next 5 years, breaking that paradox. You have to tackle the high cost of these low cost decisions that you've made for sometimes 30, 40 years and look at modernizing those cores. Otherwise, you will be perpetually stuck in a world where you are wasting 70% of your time.
What do you think, Francesca? Is that right?
Yes, absolutely. We analyzed this deeply because we saw this 70% of the spend. It's not now, there is already a while. The bank continue to maintain existing system to meet regulatory demands, but leaving little space for innovation. And we also show the macro signal because we analyzed the data from 150 largest global banks. And we see the technology cost, as Max said, is growth about 4 times faster than revenue growth over the 15 years. So they needed to modernize the technology core because we needed to create a new growth engine.
Mike, one of the things that I thought was really interesting is this idea that banks are moving toward open source solutions. That's not something you would have ordinarily thought about 10 years ago, but it's happening now. What does that entail for banks? Why are they doing it and what do they need to do?
Yeah, and it's a fascinating point because when you say when we first said, oh, banks are moving towards open source, people are like, nah, not happening. And but then you look at the cloud providers and you realize that every single cloud provider is based off of Linux, which is an open source operating system that provides you containers to run your applications. And so unbeknownst to many executives, banks are already substantially moving towards an open source foundation at the operating system level as they move to the cloud or frankly on-prem. And what we're seeing is we're seeing that same thinking amongst leading banks is that they are moving many of their application capabilities further up the stack beyond just the operating system into the workflows and other applications into open source. And there's a group out there that is fascinating called Finos. And Finos is a consortium of almost 100 banks now that have committed to sharing their code amongst each other. And to make this real, I was in let's just say a Southeast Asia country talking to a CEO of a brand new bank that started the bank, and I was talking to them about open source. And he stopped me and he said, Mike, he goes, dead right. He goes, you know what? He goes, we've based our entire data system off of Goldman Sachs's Legend data technology. So that makes it real. This isn't just theoretical. Banks around the world are already using open source to make it happen. And one step further, which is beyond fascinating, when you look at Nubank down in Brazil, which is an attacker bank down there, everyone always asks, how can Nubank per account run at a much lower cost? When you dig underneath Nubank and you look at their disclosures, what you find is Nubank is built 100% off of open source. Does that mean every bank in the world is going to go 100% open source? No. But it does mean that if you want to think about how to get these expenses under control and how to think about driving it, that is going to be a powerful lever for you.
Francesca, what do you have to say?
8 in 10 banks plan to increase the adoption of open source software over proprietary vendor platform over the next 3 years, because open source adoption can reduce the legacy compute cost and software cost by 50 or 90%, and also can increase the delivery speed.
Yeah, I was just going to say, this sounds like it might actually help companies scale a little faster. Are banks successfully scaling their AI efforts, Francesca? And if so, what are they doing differently than the banks that can't scale their AI efforts?
What we saw over this year is the piloting. The banks are making lots of pilots. Now it's time to scale. So we see increase in the number of banks that are starting to scale, because we started with AI, Gen AI, and now agentic. We call them advanced AI. They understand the importance to apply, deploy AI across in a different value pool. Given that the benefits, they're starting to become visible. Think about JP Morgan that announced 2 billion of benefits, and now DBS in Singapore announced 1 billion. There is a lot of opportunity, and now it's time for the other banks to understand, to catch up the leaders.
Mike, as you scale, I assume risk scales with you. What are the biggest blind spots that banks are facing right now in order to manage the risks and the regulations that are coming?
When you look at risk and regulations, the report, and we did a lot of research on this, it's quite fascinating, is that what we found since the great financial crisis, have done an enormous amount of efforts putting in what I would call controls on every single process and component out there, right? But in the process of that, you still had Silicon Valley Bank happen in terms of the failure. And when you look at that, what you realize is that we've pixelated risk, meaning if you look at a picture and you look at it up really close, all you're going to see is the pixels. But when you step back, all of a sudden, you can see that it's a Mona Lisa. And what banks need to focus on when it comes to risk is, yes, control the pixels, but they really need to step back and look at the totality of the risk, especially when it comes to generative AI, because it's not about just controlling one little process here or there. It's about looking at the totality of what you're doing and what new vectors you're opening up across the board. And I think that is going to be the big shift you're going to see over the next 4 or 5 years, is stepping back and asking, what's the totality of what's really going on here versus just controlling every single little point.
How have banks been doing this, Francesca? What do you think? They've been successful?
Absolutely. Risk is multiple. We say risk is everywhere. We see risk in financial, operational, cyber, and geopolitical. What is important, the bank at the moment risk were organized in silos. And this fragmented the visibility. So this is what we call pixelated lens. It's important to make a step back and create the full picture that is missing, because fragmentation is no longer simply an operational weaknesses. It is one of the bank's most dangerous blind spots. Our report direction is clear. It's about orchestration, because banks needed to add a layer over the side controls and move toward a continuous adaptive risk management. We call them risk management by design.
Another turn of phrase that I loved in the report is the battle for the balance sheet. Francesca, what is the battle for the balance sheet and why is it intensifying?
We love this point. With Mike, we have been analyzing this data for years, about to understand how the digital challenge in banks are moving. And after 25 years, we noticed that none of them is challenging banks in terms of assets. If we consider the total the ranking of total bank by asset, we don't notice none of them. There is some example of winner in the UK, in Brazil, Nubank, but they are very, very far to become a real competitor of banks. So we noticed that now the game is moved in another area, which is not on the fee income, where this fintech on the banks have started to work about, in particular in the payment on the fees. Now given that there is this kind of new challenge, we spoke about stablecoin, we spoke about, there is a lot of discussion about private credit. These actual stablecoin, as we said, in private credit, like Apollo, they act outside the banking regulatory system. That it could be the next frontier of competition. And they attack the fortress of the banks, which is the balance sheet, means bank lending and deposit. So this, given that the 2/3 of the global revenue are made by deposit and lending, this is an area of the competition in which the bank, they act with a defensive approach, but also offensive approach.
Mike, who's winning the battle of the balance sheet right now? Which companies and what solutions are helping them get there?
Yeah, as Francesca mentioned, it's 25 years no digital bank in the top 250 globally is the short version of it. And that's because banking is a business of scale, and it's mathematically limited to its growth rate by the return on equity. So you can't grow a bank faster than you can have your return on equity, which means it's a natural throttle to growth. When you look at banking, though, from just simply the balance sheet and over the top, you can attack banking from the balance sheet side. You can go at it much more effectively. So to answer your question, on the asset side, which is the lending side of the balance sheet, private credit is a fantastic example. And you can see how Citi's partnered up with BlackRock and even admitted that they may not be able to actually do commercial credit as well as they can as a private credit player can do. So they're actually partnering up. So you're seeing a lot of the PE firms come in on the private credit side that are replacing commercial lending. Then what you have, and this is still TBD on the consumer side, but if you think about consumer deposits, which is where an enormous amount of profit is made, especially in the United States, just envision a future where you go to ChatGPT and you say, optimize my idle cash for me. And you link it to your bank account. And maybe you have $5,000 sitting around there. And all of a sudden now that money can be moved around and simply arbitraged, right? If just 15% of the people in the United States do that, you can wipe out 25% of the net income in banking. That's an example. Hasn't happened yet, but it's a fantastic example of a battle for the balance sheet does not require you to become a bank anymore.
Let's move on to the lightning round of the Accenture research brief. Mike, give us the one number that you think should make executives sit up when they read this report.
10x. Your company's, if you're 20,000, you're going to be 200,000. And you have to be thinking that way. You cannot think of generative AI and what's occurring right now as being constraining. You have to think about how it's going to unconstrain the work that you can do if you want to be able to compete going forward.
Francesca, what's the one number that you saw in the report that you think would make CEOs sit up in their chair?
22% of US bank pre-tax income could be at risk if are not moving fast, because the leading global banks get approximately 2/3 the revenues from net interest income. So there is a disruption on the deposit lending, and they needed to absolutely consider this revenue at risk.
Mike, what do you think the future of banks will be given everything that we discussed that's in the report?
I think it's going to be incredibly bright. I'm a Tigger. I'm an optimist on this. I believe we are going to be able to move beyond this world of digital that's great, but it's functionally correct emotionally devoid, put context back into it, have experiences that feel much more like the personalized banking of 30 years ago, where a branch manager knew everything about you, and it was a continuity of conversation over time and channel. I see an incredibly bright future for banking, for the banks that take advantage of what we learned.
Francesca, what do you have to say?
Banking needed to have the Netflix moment, because it is one very nice conclusion. Netflix, it is a disruption, and banks they have the possibility to propose something very innovative.
All right, Francesca, here's another lightning round question for you. If you're a banking CEO watching this, what's the one decision that you can't afford to delay? What's something you have to do right now?
Cannot wait and see. You needed to act. You needed to consider the amount opportunity you are in front of you. It's time to act.
Mike, final word. What's the one decision they can't delay?
No more science fair projects. You need to scale generative AI.
Thank you so much, Michael, Francesca. I'm Juan Martinez, and this has been the Accenture Research Executive Briefing. To learn more, be sure to download the report, Top Banking Trends 2026, Unconstrained Banking. Michael, Francesca, thank you again. Have a great day, everyone.